The Silicon Valley Bank chaos is being cleared up, but what exactly went wrong with the bonds the banks were holding? Well, the banks were holding government 10-year Treasury bonds, a great idea as a safe place. But when there was a run on the bank, those bonds were not worth enough to cover the cost. John Bever, President and Chief Investment Officer of Phase 3 Advisory Services, is here with a breakdown. One of our viewers wrote to say he's very concerned about the banks and bonds. What can you tell us?
So banks can hold their bonds in two buckets. They can hold it in a bucket that's available for sale, or they can hold it in a bucket which is held to maturity. If you have the bucket that's held to maturity, those bonds are valued at par value or the maturity value. If you hold it in available to sale, then that bucket is marked to market. It's actually the current market value of those bonds. Well, Silicon Valley Bank had all their bonds on the held to maturity side. So they were being held at the full value. They were not being marked to the market. Well, that creates a problem. Suddenly you have a bunch of depositors that want their money back because they have to sell those bonds at then a loss. So that's really what happened with Silicon Valley Bank. It is pretty much an isolated situation because most banks do not manage their assets that way.
Please explain how the banks have a reassignment of bonds.
So the banks actually can move these bonds back and forth from one side to the other whenever they want to. So there was a reclassification last year. I believe it was about 12% of bonds moved from available for sale to held to maturity.
What is the Fed doing now?
The Fed is providing a lot of liquidity, and they have more liquidity that they can provide. So they're not going to provide more than is needed. They're not going to provide less than is needed. They're trying to find that magic middle, the Goldilocks amount. So as needed, and this is what's raised some of the questions, as needed, they're going to provide that liquidity. That's why Janet Yellen was a little evasive in some of her testimony, not saying, are we guaranteeing all deposits? She didn't say they're guaranteeing all deposits. They shouldn't have to. But if there is another bank that gets into trouble, they will provide availability.
So there's no need to worry.
Correct. No need to worry.
Very good. Thank you, John.
You're welcome.
Go to businessfirstam.com for where to see our show on TV.